Which stock you are likely to buy? One with a price tag of 10,000, another with a price tag of 300. If your answer is 300, then this episode is exclusively for you. Please stick with me until the end because you are going to have lots of key takeaways. Usually people who prefer to buy cheap stocks, low value stocks, they do so and justify their actions saying that I'm here for a long haul. I want to buy and accumulate more quantity because whenever stock price will appreciate, I will gain more. Another argument is that if I buy expensive stock, for example, stock worth rupees 1,000, 5,000, 10,000 and so on, then those stocks have already appreciated. I am not going to gain anything from those levels. Well, I would say these are plausible arguments, but frankly, they don't stand any ground. So now let me give you one scenario, of course hypothetical one. For example, this being a millet year, Chef A is going to call a group of 10 people and he is going to make 100 rotis of different millet, varieties of millets for them. On the other hand, Chef B is also making 100 rotis, but he is calling a group of 20 people. Chef A is charging an entry fee, of course concessional entry fee, of rupees 100 per person. On the other hand, Chef B is going to charge you 50 bucks as an entry fee. Now tell me, if pricing or affordability is the only concern that you have, then which one is better and cost effective? Both the options are more or less same, right? Then why deviate from this stand when it comes to stock market investing? Now let me introduce two concepts here. For the time being, forget about these people, forget about chef and all. Replace your rotis with earnings. Replace people with number of shares. And then replace entry fee with pricing. Alright. Now if you divide earnings by number of shares, what you get is earnings per share, which is also called EPS. If you divide price by EPS, what you get is PE. You have heard this before, right? Is it so simple? Yes, it is so simple. And this becomes your valuation ratio. This multiple can be used as the easiest factor to evaluate stocks, whether they are cheap, expensive and so on. But mind you, this is not the end of the world. This is rather a beginning. Alright? So now let me give you a very real life example. I am going to compare two companies, Raj Industries and Lakshmi Machine Works, on three parameters: number of shares outstanding, earnings for the past 4 quarters and their price. Look at their price. It's in such a stark contrast. One is around 350, another is around 10,000. But now look at their multiples. They're more or less same, right? So that's what exactly I was trying to tell you in the beginning. 300 is not cheap, 10,000 is not expensive. It's in relation to something else, and that something else is PE multiple. So if you think you have learned something new today, which is going to be quite handy, which you can keep in your back pocket and use whenever you want to analyze stocks, or rather start analyzing stocks, then please don't forget to like this video and share this video with your friends, because let them also understand something so interesting that you have got to understand today. And if you want to continue to receive such interesting content in future, then please don't forget to subscribe to this channel. And I will never be tired of saying the same thing over and over again. You have to take care of your money, because if you don't, then nobody else will. See you next time. Mind your money.